You've been doing everything right, saving, investing, trusting the market to reward you in the long run. But what if I told you the next couple of years could give you zero real return, even if the market looks fine today? That's the silent warning Warren Buffett just gave. No big speech, just one massive move, holding over $347 billion in cash. And it's eerily right before past crashes. This isn't a random decision, it's a pattern, a blueprint, and if you miss the signals now, it could cost you years of growth. So in this video, I'm breaking down exactly what Buffett is doing, why he's doing it, and how you, even if you're not a billionaire, can protect yourself using the same playbook. Because this isn't just market analysis, this is your future. Warren Buffett, the man behind Berkshire Hathaway, is famous for his calm during the chaos. In Q1 of 2025, Buffett's company revealed they are holding a staggering $347 billion in cash equivalents and short-term treasury bills. That's more than 1/3 of Berkshire Hathaway's total value. Let that sink in. 1/3 of the entire empire, not in stocks, not in private deals, but in cash. Imagine walking into a store and realizing the richest guy there isn't buying anything. He's just watching. That's Buffett right now. Why is the Oracle of Omaha, who has made billions by investing in businesses, choosing to sit on the sidelines? Because he's waiting for the moment when others panic. And he steps in to buy great companies at bargain prices. He's seen this movie before, and he knows how it ends. Buffett's money isn't sitting idle either. It's earning about 4 to 5% in short-term treasuries. That's around $13 billion in annual income, just for being patient. While others rush into AI, speculative tech, and high-growth plays, Buffett is quietly collecting billions, risk-free. Buffett doesn't make these decisions on a whim. He uses data, cold hard numbers. Two key indicators are flashing red right now. The first is the Buffett indicator. This is one of Buffett's favorite tools and measures the total market cap of US stocks against the nation's GDP. It shows whether the stock market is growing in step with the real economy. Historically, if that number is above 100%, the market is overvalued. In 2000, during the dot-com bubble, it hit 140%. Right before the 2008 crash, it crossed 110%. Today, as of May 2025, it's at 210%. That's not just high, that's historic. We've never seen this kind of disconnect between Wall Street's hopes and Main Street's reality. The second is the Shiller-PE ratio, also known as CAPE, created by the Nobel Peace Prizer Robert Shiller. This ratio compares stock prices to average earnings over the past 10 years. It adjusts for inflation and smooths out the short-term spikes. A CAPE above 16 is considered risky. In 1999, it was around 28. Before the 2008 crash, it hovered near 27. Today, it's 35. That's more than double the historical average. These numbers don't lie. They tell us the stock market is dangerously overpriced. And Buffett is listening. If we look at history, Buffett's move today mirror his actions before some of the biggest crashes in recent memory. In 1999, he warned investors that the market had become too optimistic. New tech stocks, dot-com companies were priced sky high, even though had never turned a profit. People laughed. They called Buffett old-fashioned, a dinosaur. But then came the crash. From 2000 to 2012, the market delivered almost no real gains. It was the infamous lost decade, and now here we are again. But this time it's not dot-coms, it's AI, and the same pattern is emerging. In 2025, AI hype is fueling tech stock prices. Companies are trading at wild valuations. Startups with no profits are being valued like the next Apple or Microsoft. Buffett, he's not buying any of it. Then came the spark. On April 2nd, 2025, President Trump announced sweeping new tariffs. The market reaction was instant and brutal. The S&P 500 dropped over 6% in a single day. The Nasdaq fell 1,600 points. It was the worst day for tech stocks since the sickness crash. Traders panicked, investors ran for cover, pundits shouted recession. Buffett, he didn't flinch. No press conference, no tweet, no sudden trades. He did nothing because he's not trying to time the crash. He's preparing for the aftermath. That's where the real money is made. Buffett once described investor behavior like this. It's like Cinderella at the ball. Everyone knows the party can't last forever, but no one wants to leave early. The participants plan to leave just seconds before midnight. Buffett wrote, but there's a problem. They're in the room where the clocks have no hands. That's where we are right now. People know stocks are expensive, but they don't want to miss out on the next big run. Everyone thinks that they'll be the first to exit before the crash, but it never works out that way. Buffett, he's already left the party. He's in the car, engine running, watching the exits. Let's take a quick trip back to 2008. The global financial system was falling apart. Lehman Brothers had collapsed, AIG was on the edge, stocks were crashing, it felt like the end of the world. And Buffett, he had $20 billion in cash ready. He invested $5 billion in Goldman Sachs, securing preferred shares and a 10% dividend. He made similar deals with the Bank of America, General Electric, and others. Each time, he got favorable terms. Why? Because no one else had the money or the courage to step in. Those investments made Berkshire billions. While others were fleeing, Buffett was collecting assets at a discount. That's the power of being patient, of being prepared. So what's Buffett doing now? He's doing what he always does before a big correction. He's not buying stocks. He's not buying back Berkshire shares. He's not chasing hype. He's waiting. And while he waits, he's earning billions in interest. This isn't fear. It's strategy. It's discipline. It's a bet, not against the market, but for better opportunities in the future. Before he passed, Charlie Munger said, "The big money is not in the buying or the selling, but in the waiting." Munger and Buffett built an empire on patience. They didn't get rich overnight. They bought when others sold. They held when others panicked. Today, the same is guiding Buffett's $347 billion move. Some analysts say AI will lead a new boom, that innovation will keep stock prices high, that companies are finally unlocking a new productivity era. Others say the market is due for a major reset. Tariffs, inflation, interest rates, geopolitical risk, they all signal trouble. Who's right? We don't know. But Buffett's actions speak louder than forecasts. He's not making predictions, he's following a process. You don't need billions to follow Buffett's strategy. The first being building cash. Start setting money aside, even if it's small. Every dollar counts. When prices fall, you'll be ready. Having cash gives you options. No cash? No choice. The second is to avoid hype. If everyone's buying AI stocks, maybe pause, ask yourself, do I understand this company? Is there real value or just buzzwords? Another is to invest consistently even in high markets. Keep investing. Dollar cost averaging works. It's simple, it's boring, but it builds wealth. Another is to focus on income. Want more investing power? Increase your income. Learn a skill, start a side hustle, get a better job. Use the extra to invest. Also, think long term. Buffett's biggest wins came from decades of holding, not flipping stocks every month. When Buffett was 11, he bought his first stock, 3 shares of the city's surface. The price dropped, he panicked, sold for a small gain, but soon after the stock doubled. That stuck with him. Patience matter. Later, he bought Coca-Cola when no one cared. He held, it's now a top Berkshire holding. That's his edge, time. This isn't just about billions. In 2025, families are struggling. Rent is up, groceries are expensive, student loans are back. Now imagine your investments tank too. That's why this warning matters. You don't need to be scared. You need to be smart. You need to be prepared. We don't know when the crash will hit, but Buffett is showing us how to be ready. Leave the party before midnight, even if you don't know what time it is. Let's imagine a young investor named Sarah. She's 28, works in tech, and started investing 3 years ago. She's riding the AI wave. 70% of her portfolio is in growth stocks. After watching Buffett's shareholder meeting, she decides to shift her strategy. She keeps contributing to her 401k, but also builds up 6 months of cash savings. She trims some of the speculative stocks and starts investing in dividend-paying ETFs. 6 months later, the market drops 25%. Most of her coworkers panic. Sarah, she uses her cash to buy quality companies at a discount. Fast forward 5 years, she's far ahead of those who didn't prepare. That's the Buffett mindset in action. Not flashy, just effective. So what should you do? Stay calm, stay ready, keep learning. Buffett has seen this before, and his actions tell us you don't need to be Warren Buffett, but you can think like him. Be patient, be smart, be ready. Let's go even further back. The Great Depression started after the roaring 1920s. Just like today, people felt unstoppable. Then in 1929, the stock market collapsed. It took 25 years for the Dow to recover. But guess what? Some people got rich during that time. Why? Because they stayed disciplined. bought strong companies at low prices, and held for the long term. Then there was the 1970s. Inflation soared, oil prices spiked, markets stagnated, but Buffett made some of his smartest bets in this decade by focusing on real cash-generating businesses. Markets move in cycles, up, down, sideways, but patient, disciplined investors survive them all, and the best ones come out stronger. Buffett doesn't follow trends, he follows value. He's not trying to be trendy, he's trying to be right over decades. He reads hundreds of pages a day, he avoids emotion, he buys businesses he understands, and most of all, he trusts math over mood. So ask yourself, do I understand what am I investing in? Am I chasing hype or buying value? Can I stay calm if the market drops 30%? If the answer is no, then Buffett would say you're not ready. Let's talk about Jason, a retiree in his early 60s. Back in 2021, Jason had most of his savings in index funds. After hearing about crypto and tech stocks, he moved a large portion into high growth ETFs. For 2 years, he saw massive gains, but in 2024, those gains disappeared. Jason panicked, he sold at a loss. Contrast that with Maria, a nurse who simply invested 20% of her income every month into a balanced portfolio. She ignored the noise. In 2025, when the market dropped, she kept investing. 10 years from now, Maria will likely be far wealthier and far less stressed than Jason. That's Buffett wisdom at work. Stick to the basics. Don't swing for home runs. Just keep hitting singles. The market